The Reserve Bank Australia meet on September the 6th, and there are a number of factors likely to weigh on the Australian dollar going forward. You can see here that short-term interest rate markets are pricing in about a 78% chance of a 50 basis point hike. A 25 basis point hike is fully priced in. So the first thing that's potentially to weigh on the Australian dollar is that China's growth is slowing, and the Australian dollar tends to rise and fall with China's economic growth. Secondly, key export commodities from Australia have seen lower prices. You can see here iron ore prices pushing lower. We've also got copper prices pushing lower, and coal prices have been tracking lower over the last few weeks. So that is a negative drag on the Australian dollar. Thirdly, the veteran economist Saul Eslake sees the RBA abandoning the 50 basis point rate hike going forward because he expects unemployment to rise and GDP to miss the RBA's projections. So what's the potential trade? Well, if the RBA do take a more dovish stance at their upcoming rate meeting, then that can be nicely expressed through an Aussie-New Zealand dollar short at market. You see that risk can be very nicely defined just above this 200 exponential moving average, with stops sitting around this 1.12900 region. Probably just put it above 1.1300 to avoid sitting underneath a big round number. And on top of this, if you look at the seasonal factors involved, the seasonals do favour Aussie-New Zealand dollar weakness between the 6th of September and 19th of September, with 16 falls over the last 22 years. Now, the major risk with this outlook is that the RBA take a more hawkish stance at their upcoming meeting. That can lift the Australian dollar. So too, the other risk is that if there's a turnaround in China's growth picture and or commodity prices, that can also nullify this outlook. Remember, don't just trade it, seize an exit.